Hey, JJ here. Welcome back to the Art of Value. So today I wanted to address two things, just the CPI numbers for the month of March and a Cathie Wood interview from ARK Invest that I found interesting and I kind of want to react to it. So first the CPI numbers. So it's come in at 8.5%, 12-month percentage gain. There's a graph on the screen if you're on audio, and if you're on video we can see it. 12-month percent in CPI is 8.5, and all items less food and energy is 6.5. And this last month it's month over month, 1 month percent change in CPI, 1.2%, which is the highest it's been for a long time. I think. So there's a chart on the table that goes back 1 year. Last month, February, it was 0.8, then January 0.6, December 0.6. The lowest was 0.3 in August last year. So obviously last year, inflation started to take off and the Fed decided to retire the word transitory. Okay, so just a bit of commentary on that from CNBC here. We've got the Consumer Price Index, which measures a wide-ranging basket of goods and services, jumped 8.5% from a year ago on an unadjusted basis, above even the already elevated Dow Jones estimate of 8.4. Excluding food and energy, so-called core CPI increased 6.5% on a 12-month basis, in line with expectations. However, there were signs that core inflation appeared to be ebbing, as it rose just 0.3% for the month and less than the 0.5% estimate. And that in turn sparked some hope that inflation overall was easing and that March might represent the peak. Well, I think a lot of people are hoping so, that we don't get run of inflation, not least of all the US Fed, hoping that we don't, they'll be wanting it to go down. And we'll just quickly look at how the market reacted. I'm pretty sure, I don't even check this, but I think that those figures came out during the market session. So on the day, the S&P 500 was down 0.34%, Nasdaq was down 0.3%, and the Russell 2000 smaller and mid-cap stocks was up 0.33%. So that's interesting from my point of view, because that's kind of what I'm focused on, smaller and mid-caps. I think they've taken the biggest hit over the last year or so, and so I've been kind of focused on that area. It seems to be some fairly good opportunities compared to the big and mega cap stocks. Just my opinion, not investment advice at all. And so what I really wanted to get to today was this Cathie Wood interview. So the headline that you see on the page there, if you're on video, ARK Invest CEO Cathie Wood says she expects 50% compound annual rate of return over the next 5 years, which is a huge number. Not many funds have managed to achieve that over 5 years or more. Warren Buffett over 57 years, I think, about 57 now, around 20%. That's a long time though. Cathie's in her mid-60s, so she won't achieve anything like that over that long a period. But there have been managers that have over 10 or 20 years have achieved high results, like Peter Lynch. I think his was around 28% over 13 years or something like that. I don't know. Don't know exact figures. I know that Joel Greenblatt achieved 40% CAGR over 20 years, I think, with the Gotham Fund, and then he stopped it because it was getting too big, I think, or I don't know the reason, but that's a recent long run, 40%. So Cathie, well, let's just see what Cathie says here. I don't want to. I'm having sound problems. I might cut it off early if we have sound problems, but let's just see.
ARK Invest CEO and CIO, and runs some of the most popular, if not controversial, funds in the world right now. And she is with our Bob Pisani now at the ETF conference down in Miami. Bob, take it away.
Thank you very much, Scott. And of course, good to see you, everybody tuning into the Exchange ETF conference. Cathie, great to see you. It's been a rough 12 months for you, Cathie. You've been down 45% on your flagship ARK Invest. And yet you have a remarkably loyal fan base. You just had a monthly update. Can you explain to the viewers and to your loyal fan base, why should they continue to stick with you when you're down 45% on the year?
Well, I think if we put in perspective what has happened here, you'll understand some of the loyalty. First of all, we give our research away, and I think we get it back in terms of people believe averaging down into a strategy of ours, believing that we're onto something, some very big exponential growth opportunities. But if you look at the last 5 years, and we do have a 5-year investment time horizon, so let's look back and then forward. Back over the last 5 years, I don't have the exact number, but our performance, our flagship strategy, has compounded at close to a mid-20s annualized rate. And if you look at...
Okay, so she said it's compounded over at mid-20s over the last 5 years, so that's pretty impressive. Let's just check that. She said she didn't know the exact number. So on Ticker Terminal here, we've got the ARKK stock fund, their flagship fund. So if this is correct, Ticker Terminal should be correct. So over 5 years, it says 21.3% CAGR as of today. So price return of 163% over the last 5 years, 21.3%. And so going back 3 years, that's 7.2%. So obviously the 5 year and the 3 year incorporates that big drop from the peak of $154.50 around there, and now it's under 60 years today. But all time, so 7.42 years going back to 2014. I think that'd probably be all of it. It's 16.8% CAGR. So the length of the fund. And, one of the things that has been said, and Peter Lynch said this about his fund, that people did a lot of, I think he said most, or it's been said that a lot of people didn't make money in this fund. I mean, the fund did very well over time, but a lot of people didn't do well because they bought on momentum on the way up near the peak. You see on the screen, you see in 2020 ARK went way up, and they bought near the peak, and then they actually didn't average down. They sold on the way down as it started to drop in fear, and then kind of didn't buy at the bottom because it was too fearful. They're thinking that's it. So people didn't ride the roller coaster. So I hope this is correct, that people are sticking with it. If that people are loyal, it does seem to be the case that people haven't been running for the hills with the ARK. I saw that people have been fairly faithful, and they say that in the video. Okay, let's carry on and see if the sound holds up.
Active management generally out there, I think that only 25% of all active managers in the last 10 years have outperformed, and of the large cap managers, I think it's 11%. So last 5 years, yes. COVID, we got killed going into COVID, and our mantra was innovation solves problems. We started doing a YouTube video. From the trough in COVID to the peak, we were up 360%. And at the end, I was saying, keep some powder dry. Now, down this much, we're saying, if you believed that at the peak, when we expected our total return for the next 5 years to be 15% at a compound annual rate, if you believe that then, what has happened since? Prices have come down, but our models, actually, our earnings return expectations have...
Okay, before she talks about the return expectation, I just wanted to address that I do think it's a bubble. Call it the innovation bubble, the COVID beneficiary bubble, the innovation stock bubble, the emerging growth bubble. I don't know what it's going to be called, but I think I classify it as a bubble. And a few episodes ago, I did a couple of episodes on a book called Boom and Bust, looking at global financial bubbles, market bubbles over history, going way back hundreds of years. The South Sea bubble, Mississippi bubble, the Great Railway Mania, and this is some of them quite a few of them were technology based. Even the bicycle bubble was technology, and that was in the UK. And so the definition that they chose, and that they as a bubble, is that if it goes up 100% over, I think they said 3 years, and that was kind of quick, because sometimes it takes time. Like the .com bubble took years, but this was a fast bubble. So she said 360% up, and so definition of it going up 100% and then crashing down 50% within, I think they said, a 3 year period again. So up 100%, down 50, and this the classifier was up hundreds of percent, and then crashed 50%. So, but they're still sort of come out okay because it went up so much and didn't crash down. Like the dot-com bubble, I think the Nasdaq was like 75% down. I mean, a lot of these innovation stocks have crashed 70 to 90%, and Cathie was saying that I've heard her say before that it's not a bubble, it's not like the dot-com bubble because the companies are better off. A lot of them are better, and I do think that's true. Dot-com bubble was extraordinary in that there wasn't a lot of the companies were just kind of not even. I don't know. It's just they didn't have profits. So these ones don't have profits, but then that's not a huge thing these days when you consider Amazon or the tech companies work in a different way where they invest a lot without being profitable, even though they could. But some of them aren't, and some of them are terrible. And history will tell how it goes here. But let's just see what Cathie says. What else about the compound annual growth rate?
Have actually gone up. So over the next 5 years, we're expecting, consider the source, it's our research. Our research, I think, is the best in the business, but we're expecting a 50% compound annual rate of return.
And yet earnings returns may not.
Okay, so there we go. She's expecting 50%, which is a big call. And I just wonder, legally, is that allowed to say that? She didn't promise it. She said, consider the source, but our research is very good. So I think people would be disappointed if they don't get near that, or I guess half that would still be good. But I just wonder. I've heard podcasts where ETF managers have said that they can't talk about their expected returns, or they're not really, they're just not allowed to, or they're not allowed to talk about the returns of individual stocks. So I don't know the legal rules there, but it's a big call to say you expect it. I know she believes it, and she's not trying to con anybody there. And I actually own some of the same companies in ARK. I didn't buy them near the peak. I bought them on the way down, substantially down from their peaks because I did think it was a bubble. So I have Spotify and Square, more recently Square when it was around, because it got down below 100, which I think was, in my opinion, pretty good value, not investment advice at all. So just those two, and I think she had Pinduoduo in China. I think she might have sold out of China recently, and I think she might have had JD.com, which I don't have, but she might have had those. But I have some Chinese stocks. And so let's see what else. That's the situation there.
Not be the most important thing to you right now. It may be the path of interest rates. You were here a little while ago. You said raising interest rates might be a mistake. We had Bill Dudley, the former head of the New York Fed, last week said to get inflation under control, the Fed will need to push bond yields higher and stock prices down. They seem determined. What does this mean for the future of your portfolio?
Well, it's interesting. I think the bond market is already sending off some.
Okay, so this is in relation to inflation. Like, since inflation's been going up, interest rates have been going up. That's kind of traditionally to compress multiples on like high growth companies, high growth stocks. Because the multiples were so high during that what I think was a bubble. There was the price to sales, which is sometimes not a good thing, but just the average of some of these were just incredible. 50 times sales more in some of these software companies in particular, tech, but other emerging tech stocks, and some of them are pretty big. Tesla even hasn't. I mean, Tesla's ARK's biggest position as Tesla still is. I think it's only about 6% now that they've sold some, or they buy and sell depending on what's going on. Trade very actively. And I know people were annoyed at ARK for selling. A lot of people Palantir after the last earnings, where they're questioning whether the thesis on it had changed at all. But ARK seemed to think that it did, and sold all of it very quickly. So the 5-year time horizon became not a 5-year time horizon, and so it'll be interesting to see how that company does over the next 5 years. But yeah, so sometimes the 5-year thesis doesn't match up with what actually is going on in the fund. I think they buy the bigger ones, sell the bigger ones sometimes, and buy into smaller ones. That's where they're going. But it seemed to be holding up okay so far. We'll see. So the roller coaster, if it goes up again, I think it's kind of like the Gartner hype cycle, where we have the peak of inflated expectations, trough of disillusionment, and then the slope of enlightenment and productivity, and sort of an easy slope of development, which is what happened after the dot-com bubble. I think it took years, but huge peak, trough, and then companies emerged out of like phoenixes from the ashes and then you get your Googles and your Amazons who prove themselves and go on to be some of the, as Joel Greenblatt said, some of the best companies in history in terms of how strong they are in their finances and competitive advantages. Let's see if there's anything else.
Signals. The yield curve, 2s to 10s, inverted last week. That usually means that growth and or inflation are going to disappoint or slow down relative to expectations. So the bond market itself, even though it's backed up, the bond market to this day does not believe that inflation is baked in the cake. It is interpreting what has happened as a series of supply shocks, starting with COVID, all the supply chain problems, which I never would have expected to last this long. And now we have Russia's invasion of the Ukraine, food, energy, we've got labor shortages. Well, I'm going to say the same thing that we said during the depths of COVID. Innovation solves problems. We have more problems now, and I think our ilk of stock is going to do very well if interest rates, even if interest rates back up a bit more. And the reason I say that is we do believe cyclical inflation is near a peak. If you look at last year, this time, April delivered a 0.9% CPI read. Okay, so that's our comparison. And now we're seeing used car prices fall. I think energy even is down month to month. So I think we're starting to see cyclical turn down.
Okay, so interesting. She thinks she's basically thinking inflation's peaking and their stocks will do well even if no matter what kind of thing, which I wouldn't expect her to say any different, but it remains to be seen what happens there with inflation. I can tell you just my experience. We're building a house at the moment, and so in terms of inflation peaking, I'm not in the US. I'm in a different part of the world, but the supply chain issue, inflation seems to be kind of global. Well, if you take out Asia, inflation is in New Zealand, it's going up, interest rates are going up, so similar to the US. But in terms of building a house, definitely supply chain issues. We're trying to get things locally rather than from overseas, because obviously that's going to take a long time. And so far, like structural steel for the house, we got it was double the cost, which was a shocker. It's not a huge part of the house, but that was a shocker. And some of the internal cladding, it's going to be steel on the outside of it, and the internal cladding, we can't actually get it. Looks like it might be 6 months to get this thing, so we're going to replace it with some other material that's might be more expensive but available. And so, and obviously food, and it's obvious. So I don't see it peaking and compounding with supply chain issues. We'll see. I'm not predicting. I don't know. I'm not a macroeconomist, and I look at individual companies. But I just wanted to address that for now. And if you like this video, if you want to see more, subscribe on YouTube, subscribe, hit the notification bell. I see there's a notification bell on Spotify now, so you can follow there and be notified of upcoming videos. And on both of those are video, and then everywhere else audio. Subscribe and like, and thank you, and I'll see you next time.